Hi, welcome back to Corporate Lens. Today I'll break down Q1 FY26 earnings conference call of HDFC Bank held on July 19th, 2025. This is a deep dive into the strategy, outlook, and performance straight from the management's mouth. I'll stick to a clean and structured format that may helps you understand everything that matters, whether you are an analyst, an investor, or just curious about India's largest private sector bank. This video is for educational and informational purposes only. Let's start with what the leadership had to say. CEO Shashidhar Jagdishan opened the call by acknowledging global volatility and tariff related uncertainties. But he emphasized that India's macro environment remains strong thanks to stable inflation, a good monsoon outlook, and supportive government policy. The bank has grown average deposits by 16% year on year, while asset growth was intentionally slowed to 7% in the previous year to bring the credit deposit ratio down from 110% to 95%, a key post merger goal. Tone wise, the management was calm, confident, and very clear in their strategy. They have shifted gears from a correction phase last year to re-acceleration this year. There was strong appreciation for employees and shareholders. Importantly, they announced a 5 rupee per share interim dividend and 1:1 bonus share issue. Now, let's talk about one of the most critical parts of the earnings call, the bank's future outlook and guidance. Management expects loan growth to catch up to the industry in FY26 and outpace it in FY27. They are seeing improved traction already, with loan growth picking up to 8% in Q1 FY26. The bank remains confident that improved rural demand, festive spending, and lower inflation will boost consumption. While there may be quarterly margin fluctuations due to repo rate cuts, the expectation is for gradual stabilization. In short, the bank sees strong visibility on growth but remains realistic about margin pressure in the near term. Their tone was confident but not overly optimistic. They are balancing ambition with caution, and that's something investors should take note of. Next up, let's understand the industry and macro trends. What the bank's management had to say about the broader environment. In terms of broader context, the management acknowledged global risks, especially from tariffs and geopolitical tensions. However, they reiterated that India remains well positioned. Lower food inflation and personal tax cuts from the budget are expected to boost domestic demand. They also pointed to the steady policy support from the government and RBI. The overall message, while the world slows, India is relatively resilient, and that helps the banking sector. The takeaway, while the global environment remains cloudy, the domestic setup looks strong, and that puts Indian banks, especially HDFC Bank, in a relatively advantageous position going into the rest of FY26. Now let's talk about where HDFC Bank stands compared to its competitors, a point that came through quite clearly during the call. First, the bank acknowledged that competition in the mortgage space is heating up, especially from public sector banks. These PSUs are offering home loans at aggressive pricing, which is putting pressure on spreads for everyone in the market. But HDFC Bank is not playing the price war game. Instead, they are staying selective, focusing on profitable growth over chasing volumes. That means they're willing to lose out on some low yield business if it doesn't meet their risk return threshold. And this is a critical differentiator. Even in the corporate loan segment, the environment has become more competitive with tight pricing and short tenure deals. But HDFC Bank says it's being strategic, focusing more on AA and AAA rated borrowers where the risk is lower and relationships are long term. They also spoke about Housing Development Bank Financial Services, their NBFC arm. Many investors worry about overlap or cannibalization, but the bank clarified that HDB serves a different, low credit rated customer base. So there is no conflict or competition internally. So, what's the bigger picture here? While many banks are running after growth at any cost, HDFC Bank is trying to balance profitability with scale using its brand trust, diversified reach, and product mix. They are playing the long game, and that's an important lens for investors watching the private sector banking space. Now let's look at the part that most investors tend to skip but should not, the risks and the concerns. Even though the overall tone of the call was confident, HDFC Bank's management did not shy away from acknowledging the key pressure points. First, the margins. With over 70% of the bank's loan being floating rate, any cut in repo rates impacts the loan yields immediately. But on the flip side, most of the deposits, especially fixed deposits, don't reprice that quickly. This creates a timing mismatch which compresses the net interest margins. Second, the CASA pressure. Post the merger, the CASA ratio dropped from 41% to around 38%. And this is a concern because CASA is a cheaper source of funding for a bank. Lower CASA means higher cost of funds. While management is working on rebuilding it through better customer engagement and cross selling, the recovery won't be immediate. Third, fierce competition. In the mortgage and corporate lending space, public sector banks are offering extremely competitive rates, and that is squeezing everyone's margins. HDFC Bank is not playing the price war, but it does mean they might lose out on some volume growth in the short term. Fourth, the credit cost normalization. Currently, the bank's asset quality remains strong, but they did flag a seasonal uptick in credit costs, especially from agri lending. And lastly, there's always the external risk from regulatory changes, global macro headwinds, and slower than expected capex revival. Let's talk about what's driving growth. The bank strategy includes upselling multiple products to existing customers, particularly to regain low cost CASA deposits. They are investing in digital platforms and enhancing the customer experience. More updates expected in the second half of FY26. Rural penetration is a strong focus area, as is MSME lending. The recent IPO of Housing Development Bank Financial Services provided capital and visibility, and they plan to selectively support corporate working capital loans. In short, it's a multi pronged strategy: geographical, segmental, and digital. Moving to product trends. Loan growth has started recovering post merger, and the reclassification of business segments like commercial and rural banking reflects better internal alignment. CASA, as mentioned earlier, has declined, but management is now pivoting from deposit mobilization mode to engagement and upsell mode to improve the mix. Retail remains dominant, but MSME and rural are gaining attention. They are also optimizing mortgage processing costs to stay competitive. Across the board, there is a push for quality, not just quantity. So, overall, the product mix is moving towards a more balanced, strategically diversified portfolio with a plan to grow across geographies and customer types instead of chasing just one vertical. So, to sum it all up, HDFC Bank has entered a new phase. After spending the last year adjusting to its big merger, the bank is now focusing on steady, sustainable growth. Loan growth is picking up again, rural demand is showing signs of improvement, and they are placing big bets on MSMEs, digital upgrades, and deeper customer engagement. Yes, there are challenges like pressure on margins, low CASA, and rising competition, especially in home loans, but the management is aware and has a clear plan in place. Overall, it's a transition quarter where the groundwork is being laid for stronger performance ahead. If you are following India's banking space, HDFC Bank is definitely one to watch. If you found this content useful, then do hit like, share, and subscribe for more such business deep dives. Have thoughts on HDFC Bank's performance? Drop your comments, and I would love to hear from you. Thanks for watching.